Welcome to Chapter 8 of FIN552, Bond Portfolio Management Strategies. In earlier chapters, we learned how to value a single bond and how bond prices move when interest rates change. Today, we move up a level, from one bond to an entire portfolio of bonds, and we ask the practical question that every professional bond manager must answer. Given an investor's goals, how should the whole portfolio be built and managed? Over this chapter, we will meet the full family of strategies, passive ones like buy and hold and indexing, active ones like interest rate anticipation and credit analysis, the core plus blend, the matched funding strategies that guarantee future obligations are met, and contingent immunization, which chases extra return while protecting a flaw. By the end, you will be able to explain each strategy, tell passive from active, judge which suits which market, and recommend the right strategy for a given investor. Let us begin with a simple but powerful question. Let me start with a thought experiment. Imagine someone handed you 100 million ringgit today and asked you to invest it in bonds. How would you do it? Your answer cannot just be buy some bonds, because you first have to know what the money is for. Are you trying to generate a stable income, to preserve the capital, or to minimize risk? Different goals lead to genuinely different approaches. As you can see on the slide, the same 100 million could be run as a simple buy and hold portfolio, as an actively managed portfolio that tries to beat the market, as an index portfolio that tracks a benchmark, or as an immunized portfolio designed to guarantee a future value. Each of these is a real named strategy that we will study today. The key lesson to hold on to from the very start is that there is no single best strategy. The right choice depends entirely on the investor's objective. Let us see who actually makes these choices in the real world. Bond portfolio strategies are not just academic. They govern how the world's largest pools of money are managed. Look at three very different institutions. First, pension funds such as our own EPF and KITWAP, and retirement funds worldwide. Their primary objective is to meet future retirement obligations, so their key concern is making sure there is enough money for retirees when the time comes. Second, insurance companies such as Prudential, AIA, Ethica, and the Takaful operators. Their objective is to pay future claims and policy benefits, so their concern is matching their assets to those future liabilities. Third, bond mutual funds and fixed income unit trusts. Their objective is to outperform a benchmark return, so their concern is generating competitive returns for their investors. Notice the pattern. Different institutions have different objectives, and those different objectives lead them to different strategies. A pension fund worried about future liabilities will manage money very differently from a bond fund trying to beat the market. These institutions manage billions using exactly the strategies in this chapter. Here are the 4 learning outcomes for this chapter, each tagged with its Bloom's taxonomy level, so you can see the level of thinking expected. The first outcome, at the understand level, is to explain the different bond portfolio styles and management strategies. The second, at the apply level, is to differentiate between passive and active bond portfolio management strategies. The third, at the analyze level, is to analyze the suitability of each strategy under different market conditions. And the fourth, at the highest evaluate level, is to evaluate and recommend the most appropriate strategy for different investor objectives. Notice the journey built into these outcomes. We move from simply understanding the strategies to differentiating them, to analyzing where they fit, and finally to recommending the best one. In other words, from understanding strategies to recommending strategies. That progression is exactly how the chapter is organized. Here is our roadmap for today. We will travel through 7 stages. We begin with portfolio style, learning how bond portfolios are classified by their credit quality and their interest rate sensitivity, captured in something called the bond style grid. Then we study the passive strategies, buy and hold and indexing, which keep trading to a minimum. Next, the active strategies, interest rate anticipation, the ladder and barbell ideas, valuation, credit analysis, and bond swaps, which try to beat the market. Then the core plus strategy, which blends a stable passive core with an active plus sleeve. After that, the matched funding strategies, dedicated portfolios, immunization, and horizon matching, which exist to guarantee future obligations are met. Then contingent immunization, which allows active management while protecting a safety cushion. And finally, a strategy selection framework that ties everything together by matching each strategy to an investor's objectives. So we move from classifying portfolios all the way to recommending a strategy. Let us start with Section 1, Portfolio Style. We begin with Section 1, Bond Portfolio Style. Before we can choose a strategy, we need a way to describe and classify what kind of bond portfolio we are dealing with. In this section, we will see that two characteristics, credit quality and interest rate sensitivity, do most of the work, and together they form a simple but powerful map called the bond style grid. Before discussing any strategy, we must understand what actually drives a bond portfolio's performance. Professional managers focus on two key dimensions. The first is credit quality, which is the issuer's ability to repay its debt. Higher credit quality means lower default risk, more stable performance, but a lower expected return. You are paid less because you are taking less risk. Lower credit quality means higher default risk and higher risk overall, but in exchange, a higher expected return. The second dimension is interest rate sensitivity, which is how much a bond's price reacts when interest rates change. Higher sensitivity means larger price swings, higher risk, and greater volatility, while lower sensitivity means smaller price changes, lower risk, and more stable performance. The simple equation to remember is this: bond portfolio performance equals credit quality plus interest rate sensitivity. Almost everything in this chapter comes back to managing these two dimensions. Let us formalize these two dimensions into a framework. Credit quality measures the issuer's ability to repay its debt, and we sort bonds into two broad categories: investment grade, the safer, higher rated bonds, and high yield, the riskier, lower rated bonds that pay more. Interest rate sensitivity measures how much a bond's price changes when interest rates change. And again, we have two categories: low sensitivity and high sensitivity. The important idea is that every bond portfolio can be positioned according to where it sits on these two dimensions. How good is its credit, and how sensitive is it to interest rates? When we put these two dimensions together, as a vertical axis and a horizontal axis, they form what is called the bond style grid, a simple 2x2 map onto which any bond portfolio can be placed. We will look at each dimension in turn, then assemble the grid. Let us look more closely at the first dimension, credit quality, which determines the level of default risk in a portfolio. On the left, we have investment-grade bonds with typical ratings of AAA, AA, single A, and triple B. These are issued by financially strong borrowers, governments, and highly rated companies, so they have a strong financial position, a low probability of default, more stable returns, and lower risk. On the right, we have high-yield bonds, sometimes called junk bonds, with ratings of BB, single B, triple C, and below. These come from weaker issuers, so they carry a higher probability of default and higher credit risk, but to compensate, they offer greater return potential. The relationship is the fundamental one in all of finance. Lower risk brings lower return, higher risk brings higher return. So credit quality is really a dial. Turn it toward safety and you sacrifice yield. Turn it toward risk and you are paid more for the danger. Now, the second dimension, interest rate sensitivity, which tells us how strongly a bond's price reacts to interest rate movements. On the left, low sensitivity bonds, typically short-term government and corporate bonds, and money market instruments. For example, a 2-year government bond. This shows smaller price fluctuations, lower volatility, lower interest rate risk, and more stable performance. On the right, high sensitivity bonds, typically long-term government and corporate bonds, for example, a 20-year government bond. These show larger price fluctuations, higher volatility, and greater price uncertainty. The driving idea, which we will return to many times, is that longer maturity, longer duration bonds are far more sensitive to interest rates. So higher sensitivity leads to greater price volatility, which means higher risk. Lower sensitivity, by contrast, gives more stable prices and lower risk. So when a manager wants to control how much the portfolio swings with interest rates, this is the dial they turn. Now we combine both dimensions into the bond style grid. Picture credit quality on one axis and interest rate sensitivity on the other, creating 4 quadrants, and every bond portfolio can be placed into one of them. In the capital preservation quadrant, we have investment grade bonds with low sensitivity. For example, short-term government bonds, the safest corner. In the conservative duration quadrant, investment grade but high sensitivity, for example, long-term government bonds, safe credit but exposed to interest rate swings. In the income-oriented quadrant, high yield but low sensitivity, for example, short-term high-yield bonds, taking credit risk but little interest rate risk. And in the aggressive quadrant, high yield and high sensitivity, for example, long-term high-yield bonds, the riskiest corner, taking both credit risk and interest rate risk together. The grid is powerful because at a glance it tells you the risk character of any portfolio just from where it sits. A manager chooses a quadrant to match the investor. Cautious investors live in the bottom left, aggressive investors in the top right. With this map in hand, we are ready to study the strategies themselves, beginning with the passive ones. We now move to section 2, passive strategies. Having learned how to classify bond portfolios, we turn to the simplest family of strategies, the passive ones. The defining idea of passive management is to keep trading and forecasting to a minimum, and simply to match the market or hold to maturity, rather than trying to outsmart it. We will study the 2 main passive strategies, buy and hold and indexing. So what exactly are passive bond portfolio strategies? A passive strategy focuses on maintaining a bond portfolio with minimal trading and little or no attempt to outperform the market. The aim is to match market performance while keeping trading activity and investment costs low. The key characteristics are a long-term focus, holding bonds for extended periods, low portfolio turnover with minimal buying and selling, and therefore lower transaction costs. Passive managers do little or no active interest rate forecasting, and they emphasize stable, consistent management rather than market timing. There are 2 major passive strategies that we will examine in detail. The first is buy and hold, where you purchase bonds and simply hold them to maturity. The second is indexing, where you construct a portfolio designed to track a bond market index. Both share the same passive philosophy: do less, trade less, and let the bonds do their work. Let us start with the simplest of all: buy and hold. The buy and hold strategy is the simplest passive approach of all. By definition, it involves purchasing bonds and holding them until maturity, regardless of short-term price fluctuations. The process is straightforward. You purchase the bond, you receive the coupon payments along the way, you deliberately ignore short-term price movements. You hold until maturity, and at maturity, you receive the face value, the principal, back. Its key characteristics are a long-term investment horizon, bonds are held to maturity, minimal trading activity, bonds are rarely bought or sold, predictable cash flows from the regular coupons, and low transaction costs because you trade so little. A simple example: an investor buys a 10-year government bond and holds it for the full 10 years, collecting the annual coupons. Why do investors use it? Because it is simple to manage, it has low transaction costs, and it provides a predictable income stream. Buy and hold investors care about steady income and getting their capital back, not about trading profits. Let us weigh the buy and hold strategy fairly, its advantages and its disadvantages, because no strategy is perfect. On the advantages side, it is simple to manage, requiring minimal monitoring, which is ideal for long-term investors. It has lower transaction costs because of the few trades. It provides predictable income from regular coupon payments, and it reduces emotional investing, since you are not reacting to every market wobble. On the disadvantages side, you miss trading opportunities. You cannot profit from favorable market timing. Interest rate risk remains. If rates rise, your bond's market value falls, even if you intend to hold it. There is inflation risk. Your fixed coupons may lose purchasing power over time. And there is limited flexibility. Once the bonds are bought, the portfolio is rarely adjusted. Putting it together, buy and hold is best suited to conservative investors who value income stability and capital preservation over active trading profits. It is a quiet, patient strategy, and that is both its strength and its weakness. Let us make buy and hold concrete with a practical illustration. Mr. Hafiz purchases a 5-year government bond with a face value of 100,000 ringgit, a coupon rate of 5% per year, and he adopts a buy and hold strategy. Follow the timeline. At time 0, he invests, paying out 100,000 ringgit. Then at the end of each year, years 1 through 5, he receives a coupon of 5% of 100,000, which is 5,000 ringgit. So that is 5,000 ringgit a year for 5 years, 25,000 ringgit in total coupon income. Then at the end of year 5, on top of the final coupon, he also receives the principal of 100,000 ringgit back. So his total net profit over the 5 years is the 25,000 ringgit of coupons, since his principal simply returns to him. Notice the source of his return. It is coupon income plus the return of principal at maturity, not capital gains from trading. That is the essence of buy and hold. Earn the coupons, get your money back, and do not worry about the price in between. The second passive strategy is indexing. Its objective is subtly different from buy and hold. The goal here is not to beat the market and not simply to hold to maturity, but to closely match or replicate the performance of a chosen bond market index. Unlike active managers, index managers make no attempt to outperform. The process is to select a benchmark index, construct a portfolio that matches the composition of that index, Monitor the tracking error, which is how closely your returns follow the index, and rebalance periodically to stay aligned. The key characteristics are that it is benchmark-oriented, broadly diversified across many bonds, has low portfolio turnover, lower management costs because less research is needed, and a constant focus on minimizing tracking error. Examples of bond indices include, in the Malaysian market, the FITSE Malaysian Government Bond Index and the Malaysian Bond Index Series, and globally, the Bloomberg Global Aggregate Bond Index and the ICE BOFA Global Bond Index. In short, indexing is buying the whole market in miniature and tracking it faithfully. Let us evaluate the indexing strategy. Its advantages: first, broad diversification. Since you hold a large number of bonds, you greatly reduce issuer-specific risk. Second, lower management costs. Less research and forecasting is required, so fees are lower than active strategies. Third, market-level performance. You closely track the overall bond market and avoid depending on a single manager's skill. And fourth, transparency. Because the portfolio follows a published benchmark, investors can easily understand and monitor it. Its disadvantages: first, it cannot outperform the market. By design, it only matches the benchmark, never beats it. Second, tracking error risk. Your returns may differ slightly from the index. Third, limited flexibility. Managers cannot easily react to market opportunities. And fourth, exposure to weak bonds. If a poor performing bond is in the index, it stays in your portfolio too. Overall, indexing is most suitable for investors seeking broad market exposure, diversification, and low costs, who are happy to earn the market return rather than chase outperformance. Here is a practical illustration of indexing. A fund manager wishes to replicate the FTSE Malaysian Government Bond Index and has a total investment fund of 1 million ringgit. The benchmark is made up of 3 bonds with weights of 40%, 35%, and 25%. To match it, the manager simply invests in the same proportions: 40% of 1 million, that is 400,000 ringgit, into bond A, 35%, 350,000 into bond B, and 25%, 250,000 into bond C, summing to the full 1 million ringgit. Now suppose the annual returns turn out to be 5% for A, 6% for B, and 4% for C. The portfolio return is the weighted average, 0.4 times 5 plus 0.35 times 6 plus 0.25 times 4. That is 2.0 plus 2.1 plus 1.0, which equals 5.1%. And critically, because the portfolio mirrors the benchmark, that 5.1% matches the benchmark's return. The objective is achieved: match the benchmark, not beat it. Before we leave passive strategies, let us compare the two we have learned side by side. Their primary objective differs. Buy and hold aims for stable income and capital preservation, while indexing aims to match benchmark performance. Their approach differs. Buy and hold holds chosen bonds to maturity. Indexing replicates an index's composition. Trading activity is very low for buy and hold and low for indexing. Diversification is usually limited for buy and hold, since you may hold only a few bonds but broad for indexing. The risk profile of buy and hold depends on the specific bonds chosen, whereas indexing carries roughly market level risk. Buy and hold needs minimal monitoring, indexing needs periodic rebalancing. Both have low management costs, and crucially, neither requires interest rate forecasting, which is what makes them both passive. Buy and hold suits income-focused investors. Indexing suits those wanting broad market exposure, So both are passive, but buy and hold is about income and holding, while indexing is about tracking the market. Now we turn to a completely different philosophy, active management. We now enter section 3, active strategies. This is where the philosophy flips. Where passive managers were content to match the market, active managers try to beat it. They forecast, they analyze, they trade, all in pursuit of returns above the benchmark. We will study 4 major active strategies: interest rate anticipation, valuation analysis, credit analysis, and yield spread strategies. Each tries to exploit a different kind of opportunity. So, what are active bond portfolio strategies? Active strategies seek to outperform the bond market through forecasting, security selection, and continual portfolio adjustments. There are several common active approaches which we will study one by one. Interest rate anticipation adjusts the portfolio's duration based on expected interest rate movements. Valuation analysis identifies underpriced and overpriced bonds. Credit analysis invests in bonds expected to improve in credit quality. And yield spread strategies exploit changes in the yield spreads between different bond sectors. The key characteristics of all active management are that managers make decisions based on market expectations, they adjust the portfolio frequently to exploit opportunities. They rely heavily on market forecasting of interest rates, economic trends, and credit conditions. They require extensive research to find mispriced securities, and they aim for outperformance, but at the cost of higher management fees. The honest summary is this: active strategies offer the potential to beat the market, but their success depends entirely on the accuracy of the forecasts and the skill of the manager. Let us begin with interest rate anticipation. The first active strategy is interest rate anticipation. Here, portfolio managers adjust the portfolio's duration based on their forecast of where interest rates are heading. The core principle is the inverse relationship you already know. Bond prices move opposite to interest rates. So the decision framework runs like this: if interest rates are expected to fall, bond prices will rise. So the manager increases the portfolio's duration to capture a larger price increase. Conversely, if interest rates are expected to rise, bond prices will fall. So the manager decreases duration to suffer a smaller price decline. In other words, you lengthen duration when you expect a rally and shorten it when you expect a sell-off. The aim is to increase portfolio value when rates fall and to limit losses when rates rise. This strategy can be very rewarding, but notice it lives or dies on the forecast. A correct interest rate prediction improves performance, but a wrong one does real damage. Everything hinges on duration, so let us make sure we understand why duration matters. Let us pause to understand why duration matters so much, because it is the lever this strategy pulls. Duration measures how sensitive a bond's price is to a change in interest rates. The simple rule is that longer duration bonds experience much larger price changes when rates move. Compare a short duration bond, say a 2-year bond, with a long duration bond, say a 10-year bond. The 2-year bond has lower interest rate sensitivity, smaller price fluctuations, lower risk, and a more stable price. The 10-year bond has higher sensitivity, larger fluctuations, higher interest rate risk, and greater volatility. Now watch what happens if interest rates fall by 1%. The 2-year bond's price rises by roughly 2%, but the 10-year bond's price rises by about 8%, 4 times as much. That is the whole point. When you expect rates to fall, you want long duration bonds because they gain the most. And when you expect rates to rise, you want short duration bonds because they lose the lease. Duration is the dial that interest rate anticipation turns. Let us see interest rate anticipation in a practical illustration. Mr. Hafiz manages a bond portfolio worth 1 million ringgit, and he expects interest rates to fall by 1% over the next few months. He must decide whether to increase the portfolio's duration. Consider the before position. The portfolio is 100% in short duration bonds, which would rise by about 2% if rates fall. So the expected portfolio value becomes 1 million times 1.02. That is 1,020,000 ringgit, a gain of 20,000. Now consider the after position. He switches to 100% long duration bonds, which would rise by about 8%. The expected portfolio value becomes 1 million times 1.08, that is 1,080,000 ringgit, a gain of 80,000. By correctly anticipating the rate fall and increasing duration, he turns a 20,000 gain into an 80,000 gain, an extra 60,000 ringgit. That is the reward for a correct forecast. Of course, had rates risen instead, the long duration position would have hurt him far more, which is the risk he accepts. The second active strategy is valuation analysis. Here, the manager compares a bond's intrinsic value, its fair or theoretical value, with its current market price, looking for mispricing. There are two cases. A bond is undervalued when its market price is below its intrinsic value. This is a potential buying opportunity because the price should rise toward fair value. A bond is overvalued when its market price is above its intrinsic value. This is a signal to avoid or sell because the price should fall toward fair value. The core principle is simple. Buy a bond when its market price is below its intrinsic value and avoid it when its market price is above. The objective is to profit as market prices converge toward fair value over time. This is the bond market version of value investing. You are betting that the market has temporarily mispriced a security and that the mispricing will correct. The whole strategy depends on being able to compute intrinsic value accurately. So let us work through an example. Here is valuation analysis in practice. Mr. Hafiz is evaluating a corporate bond with a face value of 1,000 ringgit, a coupon rate of 8% per year, 5 years to maturity, a required return of 6%, and a current market price of 980 ringgit. Step 1. Calculate the intrinsic or fair value of the bond by discounting its cash flows at the required return of 6%. Using the bond valuation formula or a financial calculator, the intrinsic value comes to about 1,084 ringgit. Step 2. Compare that fair value with the market price. The fair value is 1,084 ringgit, but the bond is trading at only 980 ringgit. Since the market price is well below the fair value, the bond is undervalued. The manager's decision, therefore, is to buy the bond because its market price is below fair value and should rise toward it, generating a capital gain as the price converges to its intrinsic value of 1,084 ringgit. That convergence is the source of the profit. The third active strategy is credit analysis. Here, the manager evaluates an issuer's financial strength and its ability to meet its debt obligations, trying to anticipate changes in credit quality before the market fully prices them in. Two cases again. If credit quality is expected to improve with stronger financial performance and a likely rating upgrade, that is a buying opportunity. An upgrade lowers default risk, raises investor demand, and pushes the bond's price up. If credit quality is expected to deteriorate with weaker performance and a likely downgrade, that is a selling signal. A downgrade raises default risk, lowers demand, and pushes the price down. The core principle: buy a bond when its credit quality is expected to improve, and avoid it when its credit quality is expected to deteriorate. The objective is to profit from anticipated rating changes before they are fully reflected in prices. This is forward-looking detective work. You study the financials, the cash flows, and the debt levels, and you act ahead of the rating agencies. Let us see it with two bonds. Here is a credit analysis illustration with two bonds. Mr. Hafiz evaluates bond A and bond B. Both currently carry a BBB credit rating. Both have a face value of 1,000 ringgit, a 6% coupon, and a market price of 1,000 ringgit. The difference lies in their credit outlook. Bond A's issuer shows improving profitability, declining debt, and strengthening cash flow, pointing to a possible rating upgrade. Bond B's issuer shows declining profitability, rising debt, and weakening cash flow, pointing to a possible downgrade. Step 1, the credit assessment, says buy bond A and avoid bond B. Step 2, the expected market impact. Bond A, on its likely upgrade, attracts higher demand and its price rises from 1,000 to about 1,080 ringgit, a capital gain of 80 ringgit. Bond B, on its likely downgrade, suffers lower demand and its price falls from 1,000 to about 940 ringgit, a capital loss of 60 ringgit. So by acting on the credit analysis, the manager buys A for an 80 ringgit gain and sidesteps B's 60 ringgit loss. Anticipate the rating change before the market does. That is the skill. The fourth active strategy is the yield spread strategy. A yield spread is simply the difference in yield between two bonds with different risk characteristics. For example, if a government bond yields 4% and a corporate bond yields 6%, the yield spread is 2% or 200 basis points. Managers try to profit from changes in these spreads. Two cases. If a spread is expected to narrow, perhaps because investor confidence is improving and the risk premium is falling, the riskier bond's price will rise faster than the safe benchmark, giving a capital gain, so the manager buys it. If a spread is expected to widen because confidence is weakening and the risk premium is rising, the riskier bond's price will fall, a capital loss, so the manager avoids it. The core principle: buy bonds whose spreads are expected to narrow and avoid bonds whose spreads are expected to widen. This is a bet on changing risk premiums across bond sectors, and it is closely tied to the economic cycle. Spreads narrow in good times and widen in bad. Let us see the numbers. Here is the yield spread strategy in practice. Mr. Hafiz looks at two bonds of similar maturity. A government bond yields 4% and a corporate bond yields 6%. So the current yield spread is 2%, 200 basis points, and both currently trade at 1,000 ringgit. Mr. Hafiz believes economic conditions will improve over the next few months, which will raise investor confidence and cause the spread to narrow. So he buys the corporate bond, betting its spread will tighten. Now suppose he is right. The government bond's yield stays at 4%, but the corporate bond's yield falls to 5%. So the spread narrows from 2% to 1%. As yields fall, prices rise, but the corporate bond rises more because its yield fell. The government bond price edges up to about 1,020 ringgit, while the corporate bond price jumps to about 1,070 ringgit. By correctly anticipating the spread narrowing before the market priced it in, Mr. Hafiz earns a larger capital gain on the corporate bond. That is the yield spread strategy at work. Let us bring the four active strategies together in one comparison. Interest rate anticipation. Its objective is to predict interest rate movements. The manager focuses on adjusting duration. The source of return is capital gains from rate changes, and its key risk is an incorrect interest rate forecast. Valuation analysis. Its objective is to identify mispriced bonds. The focus is fair value versus market price. The return comes from price correction, and its risk is valuation errors. Credit analysis. Its objective is to anticipate credit quality changes. The focus is the credit rating outlook. The return comes from rating upgrades and spread changes, and its risk is unexpected credit deterioration. Yield spread strategy. Its objective is to predict spread movements. The focus is changing risk premiums. The return comes from spreads narrowing, and its risk is spreads widening instead. Notice the common thread. All four aim to outperform the market, but each targets a different source of return, and each carries its own forecasting risk. A skilled active manager picks the strategy that best matches their particular market view. Successful active management always requires accurate forecasting, disciplined analysis, and continuous monitoring. We now move to section 4, Core Plus Strategies. So far, we have seen pure passive and pure active management as opposites. The Core Plus strategy refuses to choose between them. It deliberately combines both. It builds a large, stable passive core and adds a smaller active plus sleeve on top, trying to get the best of both worlds, stability plus a shot at extra return. So, what is a core plus strategy? It is a blend of two components. The core portfolio, making up roughly 70 to 90% of the money, is built from high quality, diversified, benchmark oriented bonds. It provides stable income and lower risk, essentially a passive foundation. The plus portfolio, the remaining 10 to 30%, is actively managed. It holds higher yield bonds, uses sector rotation and credit opportunities, and exists purely to enhance returns. The core principle is that the core provides stability, while the plus component creates opportunities for additional return. So you are combining passive stability with active return enhancement in a single portfolio. The overall goal of Core Plus is to outperform the benchmark, thanks to the active plus sleeve, while still maintaining a stable, diversified core that keeps overall risk under control. Think of it as a safe foundation with a small turbocharger attached. Most of the portfolio is calm and dependable, while a small slice reaches for extra performance. Let us weigh its pros and cons. Let us evaluate the Core Plus strategy. Its advantages: first, a stable core portfolio of high-quality bonds that generates predictable income. Second, enhanced return potential. The active plus positions may outperform the benchmark and create capital gains. Third, better diversification since you gain exposure to multiple bond sectors, reducing concentration risk. And fourth, portfolio flexibility. Managers can respond tactically to changing market conditions through the plus sleeve. Its disadvantages: first, higher management costs, because the active portion requires research, analysis, and monitoring, making it pricier than pure passive. Second, active management risk. Poor forecast in the plus sleeve can drag down returns. Success depends on manager skill. Third, tracking error risk. The active positions may cause performance to deviate from the benchmark. And fourth, greater complexity. It is simply harder to manage than a pure passive strategy and needs continuous review. So the trade-off is clear. Core Plus offers more return potential than passive investing, but it brings additional costs, complexity, and active management risk. It suits investors who want a little more than the benchmark, but still value a stable foundation. Here is a Core Plus illustration. Mr. Hafiz manages a 1 million ringgit bond portfolio and adopts a Core Plus allocation, 80% to the core and 20% to the Plus sleeve. So the core portfolio receives 800,000 ringgit and is expected to earn a stable 5%, while the Plus portfolio receives 200,000 ringgit and, being actively managed in higher yielding opportunities, is expected to earn 12%. Let us compute the total expected return. The core contributes 800,000 times 5%, which is 40,000 ringgit. The Plus contributes 200,000 times 12%, which is 24,000 ringgit. Together, that is 64,000 ringgit on a 1 million ringgit portfolio, an overall return of 6.4%. Compare that to a pure passive 5%. The Active Plus sleeve lifted the whole portfolio's return from 5 to 6.4%, and it did so while 80% of the money stayed in the stable core. That is the Core Plus promise. Beat the benchmark modestly without taking on excessive overall risk. We now reach Section 5, Matched Funding Strategies. This is a genuinely different mindset. Up to now, strategies were judged on return, beating or matching the market. Matched funding strategies are not about return at all. They are about certainty. Their whole purpose is to make sure that specific future obligations, a pension payment, an insurance claim, a tuition bill, can be met with confidence, no matter what interest rates do. We will study 3 dedicated portfolios, immunization, and horizon matching. So, what are match funding strategies? These are liability-driven strategies. The portfolio is built around future funding obligations rather than around maximizing return. There are 3 common types. The dedicated portfolio strategy matches specific bond maturities with specific future liability payments. The immunization strategy protects portfolio value against interest rate changes by matching the portfolio's duration with the investment horizon, and the horizon matching strategy combines the two, dedicated and immunized approaches. The key characteristics are liability-oriented management, construction is driven by future obligations, cash flow matching, aligning bond cash flows with liability dates, a hold-to-maturity focus, lower reinvestment risk because needs are planned in advance, high predictability of inflows and outflows, and a capital preservation objective rather than outperformance. The whole point, summed up, is to preserve capital and ensure that future obligations can be met when they come due. If you are a pension fund that must pay retirees in exactly 10 years, you do not care about beating the market this quarter, you care about having the money ready. That is what these strategies guarantee. Let us look at the first match funding strategy, the dedicated portfolio. This is an approach in which bonds are specifically selected and held to maturity to satisfy known future cash flow needs. The construction process is logical. First, identify the future liabilities, what must be paid and when. Second, determine the required cash flows. Third, select bonds whose maturities match those liabilities. Fourth, hold those bonds until maturity. And fifth, use the proceeds, the coupons, and principal to meet the obligations as they fall due. Its key characteristics are cash flow matching, bond cash flows aligned with future liabilities, a hold-to-maturity approach, lower reinvestment risk because the plan is set in advance, high predictability, and a lower return focus. since the objective is meeting liabilities rather than beating the market. The defining feature to remember is that the primary objective is liability satisfaction, not return maximization. You are not asking which bond earns most. You are asking which bond delivers exactly the right cash at exactly the right time. Let us see how that looks as a cash flow ladder. Here is how a dedicated portfolio works as a cash flow ladder. Suppose an investor faces four future liabilities: 50,000 ringgit due in year 2, 120,000 in year 5, 100,000 in year 10, and 50,000 in year 12. The dedicated strategy meets each one by buying a separate bond whose principal and maturity coincide with that liability. So we buy bond A with a principal of 50,000 ringgit maturing in year 2, bond B with 120,000 maturing in year 5, bond C with 100,000 maturing in year 10, and bond D with 50,000 maturing in year 12. As each bond matures, it delivers exactly the cash needed to pay that year's obligation. Each bond maturity is deliberately chosen to coincide with a future liability payment date. Notice the goal. It is not to maximize returns. It is to ensure that sufficient funds are available exactly when each obligation becomes due. This is the cleanest, most intuitive form of liability matching. Line up the bonds with the bills. Let us evaluate the dedicated portfolio strategy. Its advantages: first, high cash flow certainty. Bond maturities are matched to liabilities, so funds are there when obligations come due. Second, lower interest rate risk. Since the portfolio is held to maturity, short-term price swings barely matter. Third, reduce reinvestment risk. Future needs are planned in advance. Fourth, simple liability planning. It is easy to estimate future funding availability. And fifth, capital preservation. The focus is meeting obligations, not speculation. Its disadvantages: first, lower return potential. Because liability matching, not return, is the goal, it may underperform actively managed portfolios. Second, limited flexibility. It is difficult to adjust once constructed, and changes in liabilities may force a restructuring. Third, a high initial planning requirement. You need accurate forecasts of future liabilities, and the design is time-consuming. And fourth, inflation risk. If future liabilities rise with inflation, the fixed bond cash flows may fall short. So the dedicated portfolio gives outstanding certainty in meeting obligations, but it sacrifices flexibility and return potential to get it. For a fund whose obligations are fixed and known, that is often a price well worth paying. The second match funding strategy is immunization, and this one is more subtle, so let us take it carefully. Immunization is designed to protect an investor from interest rate risk by matching the portfolio's duration with the investment horizon. The objective is to ensure that a required future value can be achieved regardless of whether interest rates rise or fall. How does it work? You determine the required future value. You note your investment horizon, the date you need the money, and you construct a bond portfolio whose duration equals that horizon. The key insight is that when portfolio duration equals the investment horizon, changes in interest rates have minimal impact on your ability to reach your target value. Its key characteristics are duration matching, interest rate protection, a long-term focus suited to a known future date, a rebalancing requirement as time passes and durations drift, and a liability-oriented purpose. The magic, which we will unpack next, is that immunization works by balancing two opposing risks, price risk and reinvestment risk, against each other so they cancel out. Let us understand why immunization actually works, because it rests on a beautiful piece of offsetting. Two opposing risks are always at play when interest rates change. The first is price risk. If interest rates rise, bond prices fall, so your portfolio's market value decreases, a capital loss, and if rates fall, prices rise, a capital gain. The second is reinvestment risk, which works in exactly the opposite direction. If interest rates rise, the coupons you receive get reinvested at higher rates, so your future value increases, a reinvestment benefit, and if rates fall, your coupons are reinvested at lower rates, so your future value decreases. Look at what happens when rates rise. Price risk hurts you, but reinvestment helps you. When rates fall, price risk helps you, but reinvestment hurts you. They always pull in opposite directions. The immunization principle is that when the portfolio's duration equals the investment horizon, these two effects offset each other almost exactly, so the investor still reaches the target future value whatever interest rates do. Price risk and reinvestment risk cancel, and the portfolio is protected. Let us see immunization in a worked example. Mr. Hafiz plans to accumulate 100,000 ringgit for his daughter's university education, needed in exactly 5 years. To reduce interest rate risk, he constructs a bond portfolio whose duration matches his 5-year horizon. He uses two bonds, Bond A with a weight of 40% and a duration of 3 years, and Bond B with a weight of 60% and a duration of 6.33 years. The portfolio duration is the weighted average of the two. Bond A contributes 0.4 times 3 years, which is 1.2 years. Bond B contributes 0.6 times 6.33 years, which is 3.8 years. Adding them, 1.2 plus 3.8 equals exactly 5 years. Now apply the immunization condition. The portfolio is immunized when the investment horizon equals the portfolio duration. Here the horizon is 5 years and the portfolio duration is 5 years. So the condition is satisfied. The portfolio is immunized. One crucial point. Notice the bonds themselves do not mature in 5 years. One is 3 years and the other is longer. It is only the weighted average duration that must equal the horizon, not the individual maturities. That is the elegance of immunization. The third match funding strategy is horizon matching, and it cleverly combines the two we have just learned. A horizon matching strategy splits the portfolio into two parts, taking the strengths of each. The first part is a dedicated portfolio, which covers the near-term liabilities by matching bond maturities directly with the upcoming obligations, giving funding certainty for the early years. The second part is an immunized portfolio, which covers the long-term liabilities by matching portfolio duration with the investment horizon, protecting against interest rate risk over the longer period. The core principle is that near-term liabilities are matched directly through cash flow matching, while long-term liabilities are protected through duration matching. So horizon matching combines the certainty of a dedicated portfolio for the years just ahead with the flexibility and protection of an immunized portfolio for the distant years. Why bother combining them? Because matching every single liability with a dedicated bond far into the future is rigid and expensive, while immunizing everything leaves the near term exposed to rebalancing risk. Horizon matching gives you certainty where you need it most, soon, and efficient protection further out. Here is horizon matching in practice. Mr. Hafiz manages a pension fund with two obligations, a 50,000 ringgit payment due in year 2 and a 300,000 ringgit payment due in year 10, for a total of 350,000 ringgit. He splits the portfolio. For the near-term Year 2 liability, he uses a dedicated portfolio, buying a bond that matures in Year 2 and delivers exactly 50,000 ringgit, so that obligation is met with certainty. For the long-term Year 10 liability, he uses an immunized segment, setting the investment horizon at 10 years and constructing a portfolio whose duration equals 10 years, so that interest rate risk is managed and the future liability is protected. By separating the short-term and long-term needs and treating each with the most suitable tool, Mr. Hafiz achieves both certainty for the immediate payment and flexibility with protection for the distant one. That is the whole appeal of horizon matching, the right tool for each part of the liability schedule, giving greater certainty and flexibility together. We now come to Section 6, Contingent Immunization. This is perhaps the most clever strategy of all because it tries to have it both ways. Pure immunization is safe but gives up the chance of higher returns. Contingent immunization says, let me actively manage and chase higher returns for as long as I can afford to. But the moment my portfolio falls to a protective flaw, I will lock in safety by switching to immunization. It is active management with a safety net. Let us define contingent immunization properly. It is a strategy that allows active portfolio management while still maintaining a minimum acceptable portfolio value. The manager is permitted to pursue higher returns through active management, but only for as long as a safety cushion exists above that minimum floor. How it works? While there is surplus value above the floor, active management is allowed and the manager chases extra return. But if the safety cushion ever reaches zero, meaning the portfolio has fallen to the floor value, the strategy immediately switches to immunization to lock in and protect what remains. The key characteristics are that it combines active management with immunization, it seeks higher returns, it maintains downside protection, it requires continuous monitoring, and it switches to immunization the moment the cushion is exhausted. So the rule is conditional. Active management is permitted only while sufficient safety cushion remains. As long as you are comfortably above the floor, play offense. The moment you hit the floor, play pure defense. Let us define that safety cushion precisely. The heart of contingent immunization is the safety cushion, so let us define it exactly. A safety cushion is the excess portfolio value above the minimum amount required to achieve the target future value. That minimum is called the floor value. Take a simple example. Suppose the current portfolio value is 120,000 ringgit and the floor value, the minimum needed to guarantee the future target through immunization, is 100,000 ringgit. Then the safety cushion is the difference, 120,000 minus 100,000, which is 20,000 ringgit. The interpretation is that this 20,000 ringgit is the buffer available for active management, the amount the manager can afford to risk while still being able to fall back on immunization. The larger the safety cushion, the greater the flexibility for active management. And the rule that governs everything: if that cushion ever falls to zero, the portfolio must immediately switch to an immunized strategy to protect the floor. So the cushion is both the license to be active and the alarm that tells you when to stop. Let us put the contingent immunization decision into a clear framework. Everything depends on comparing the portfolio value with the floor value. The decision rule is simple. If the portfolio value is above the floor value, that is, the safety cushion is greater than zero, then active management is allowed. The manager may continue pursuing higher returns. But if the portfolio value falls to equal the floor value, so the safety cushion is exhausted at zero, then immunization is required. The manager must immediately switch to a fully immunized portfolio to protect the remaining value. So active management is permitted only while the portfolio value remains above the floor. Think of the floor as a line in the sand. Above it, you have freedom to be active and aggressive. The moment you touch it, freedom ends and protection takes over automatically. This discipline rule is what makes contingent immunization so attractive to institutions. It offers the upside of active management with a hard, pre-committed guarantee that the portfolio will never fall through the floor. Now let us pull all of these strategies together. Finally, we reach Section 7, the Strategy Selection Framework. We have now met a whole toolbox of bond portfolio strategies. The natural question is, which one should you actually use? The answer, as we have stressed from the very first slide, is that it depends on the investor. In this closing section, we draw everything together and learn how to match each strategy to an investor's objectives, liability structure, and risk tolerance. Here is a comparison of the main bond portfolio strategies to guide your selection. Core Plus, its objective is a higher return with a moderate risk level and high flexibility, best for investors seeking some additional return above the benchmark. Dedicated, its objective is to meet specific liabilities with low risk and low flexibility, best when future cash flows are known and fixed. Immunization, its objective is to protect a future value with low risk and moderate flexibility, best for a single known future liability. Horizon matching, its objective is to balance certainty and flexibility with moderate risk and moderate flexibility, best when there are multiple future liabilities, some near and some far. And contingent immunization, its objective is a higher return with protection, with moderate to high risk and high flexibility, best for investors who have a surplus value, a cushion to work with. The overarching message is the one to carry out of this chapter: no single strategy is superior in all situations. The most appropriate strategy always depends on the investor's objectives, liability structure, and risk tolerance. Let us close with a revision map that ties the whole chapter together by objective, because objective is what drives the choice. If the investor's objective is to outperform the market, they look to the active strategies: interest rate anticipation, valuation analysis, credit analysis, and yield spread strategies, or to the core plus blend for a more measured reach for return. If the objective is simply to match market performance at low cost, the passive strategies fit: buy and hold for steady income or indexing to track a benchmark. And if the objective is to meet specific future liabilities with certainty, the match funding strategies are the answer: dedicated portfolios, immunization, and horizon matching, with contingent immunization for those who want to chase extra return while protecting a floor. So everything in this chapter reduces to one disciplined idea. First, identify the investor's objective, their liability structure, their horizon, and their risk tolerance, and then choose the strategy built for that goal. Master that decision, and you can manage any bond portfolio professionally. Thank you for your attention throughout this chapter, and happy investing.